Should you buy stock in the company you work for? I think the answer to that is it depends. What is your financial situation? What is the company like? How are things going at the company? Me personally, I have some thoughts. I try not to own any stock in the company I work for, and we'll talk about that here as we walk through this. There are a couple of ways in which you can acquire stock at the company you work for. You can get it on the open market at any exchange like a Robinhood, Charles Schwab, Fidelity, etc. You could get it through an employee stock participation program, which basically allows you typically to get a stock at a discount through a company. Sometimes that makes good sense. Sometimes maybe it doesn't make good sense. I'll talk through the pros and cons of that. There's also restricted stock units, which are RSU shares. Typically, these are like bonus based or some kind of incentive or long-term retention type structure in which the company is trying to give you the stocks and then they mature over time, right? Typically, it's a 3-year process where the first year you get them, you don't get anything. 1 year later, they mature, a third of it matures. A year after that, the second third matures, and then the third year matures. Now, the first option is pretty standard. Everybody's familiar with it, and that's the open market. I can go out on Charles Schwab, Fidelity, whatever, and I can buy the stock of the company I work for. Pretty risky. I'm probably not going to do that. There's no real incentive for me to do so other than if I just believe the company is going to skyrocket. Obviously, you can't be doing insider trading, so if you're in a position like that, it's not going to work. So this is probably the most risky of all of them to take. The second option is the employee stock participation program, and I'm going to give you 2 examples of where maybe it makes sense and maybe it doesn't make sense. Again, only you know your financial situation, so it really is on you to kind of figure out which example is best for you. But let me walk you through some examples that I've had in the past. I've worked for 2 companies that have pretty generous EPPs, employee stock participation programs. The first offered an employee stock participation plan where they offered me a 5% discount, but I had to hold on to the stock for a year. So I pay the money through the quarter, and as the quarter progresses, at the end of the quarter comes, they buy the stock. The stock is in a situation where I can no longer do anything with it for a year. 1 year goes by, that stock matures, I then have full custody of that stock, and I can sell it or do whatever. 5%, 1 year, anything can happen. So for holding on to my money for 1 year for 5%, that's not really that big of a return on investment for me, and I'm probably not going to take that risk personally. The second company I worked for offered a 15% discount. What made this one extremely attractive is at the end of the quarter, they went and they purchased stock, and then you could sell it right away. So there was essentially 3 days where my money was out of my possession and purchasing these stocks, where if the stock market drastically fell in that 3 days, which again, it would have to fall more than 15% on the company's stock, that would be the only way to be upside down. So what I did was I worked my way up and I started with a small investment, maybe 1 or 2% of my paycheck quarterly going into that stock. The quarter hits, they buy the stock, 3 days later, I'm selling it. Getting that money and living on that money as cash, right? And then the next quarter, bumping my contribution up from 2% to 3 or 4%, and doing that until I can max out if there was a max. Now, that's a pretty awesome way of doing that, but you also need to think about if I'm buying and selling stocks that fast, I'm going to be hit at the upper echelon of my tax bracket. So if I'm in that 22%, 25%, 30%, whatever, I'm going to get hit in those upper brackets for that stock. If I'm able to hold that stock for a year, then I would be taxed at a much less income tax rate. It's a pretty standard tax rate across the board. So only you can really, really, truly analyze that and see which one of those options are right for you. Me personally, 5% for a 1 year wait, probably not worth it. 15% for a 3-day wait, felt like easy money to me. Then we have RSU shares or restricted stock units. Again, these are typically for bonuses, job well done, some kind of retention, something to set you apart from everybody else. This is not a common offering to everybody out there. This is like typically a skill set, some kind of bonus, a retention tool, or whatever that looks like. Here's the issue with RSUs. RSUs you get issued, typically the day you get issued, they're not worth anything. They take typically over 3 years to mature. So year number 1, you're going to get a third of them to mature. Year 2, you'll get the second third. And year 3, you get the third. So it's a way of getting you to stick with the company for the long term. So what I've seen is a lot of people get like RSU shares, or maybe they did employee stock participation plan and they just held on to that stock forever. Is that a good idea? Well, Maybe, but here's something I want you to think about. Why are you holding on to that RSU shares? Really, if you're not in a position where you can control the future of that company, like an Elon Musk, Jeff Bezos, whoever, right? If you're not in a situation where you're the CEO, the commander in chief, the person pulling the strings, your money's at risk. So here's what I see a lot of. I see a lot of people get RSU shares, or they get employee stock participation, or somehow they accumulate a large number of stock for the company they work for. And the thought process is here, hey, I'm going to hold on to that, and that's going to be kind of my severance, or if things go bad, I'm going to be able to cash in on that when I need to. Or maybe they're trying to save for a bigger purchase or whatever. Here's the downsides that I want you to think about that. One, it's in a third-party vendor. It's not probably in a Charles Schwab, a Fidelity. It's probably in like a CompuShare or some other third-party entity out there that's holding your stocks. So you can't sell covered calls on it. You can't play options with it. It's just setting in that space over there. And then when you pull it out, you'll be able to do something with it. You'll have to sell it or transfer those somewhere else. Transferring is an option. You can definitely transfer those over, sell covered calls on them all day long, make a little more money on it if you have 100 shares or more. So this is for the people who are holding on to that money in that third-party vendor. They don't have to look at it. They don't have to do anything with it. And they're just thinking, hey, this is my severance. I'm holding that in case the economy goes bad or if something happens to the company. I'll have a large amount of money over there, or whatever my RSU share money is over there, to cash in when that day comes. Here's what I need you to think about with that. So if the economy goes bad, what's going to happen to the company stock? If the stock is down, your value is down. So what happens if the company has a bad time, doesn't make quarters for a couple of quarters in a row, their numbers are terrible? What happens to the company stock? It's going to go down. So both of those situations, the value of the company stock that you're holding over there has gone down. If the economy's down or the company isn't doing well, what are the things they're going to do? They're going to look to save their cost. They're going to cut them wherever they can, which often means more with less, right? So we see a lot of layoffs. We're seeing some of that right now this year. 2025 has had a lot of layoffs. So think about what could happen to you and all that money you have in those RSU shares. You're in a situation where you were saving this money as a severance. The company has not done well, or the economy has pushed the stock price down. Let's just say it was $100 a share. Now the stock is $75 a share. You've taken a 25% hit, and all that money you thought was over there as a severance, now the company's decided they want to do layoffs, and they're doing a reduction in force. So when they do the reduction in force, if you're part of that reduction in force and you have a severance of that RSU shares that you were holding on to, a self-funded severance plan, what happened? You've lost 25% of your value, and now you're without a job, looking all over again. So I encourage you guys, again, I don't know your financial advice. Only you can make the right financial decision for yourself and your family. But these are things you need to think about. So hopefully you guys have taken away a couple of different thoughts from this video. If you have, please like and subscribe down below. It means a lot to me. Hopefully I've given you guys a couple different perspectives on buying stock and holding stock of the company you work for. We talked about the open market stock, which is like buying it through Webull or buying it through Charles Schwab or Robinhood or whatever, of how there's a lot of risk in doing that. You're not getting a discount. You're not being incentivized to do so. So it's really a little risky. We talked about the employee stock participation plan. I think if you're not doing this today, you should go look and see what your company offers. You should take a look at the discounts and how long you have to hold on to that stock once it's bought. If the stock is bought every paycheck versus being bought at the end of the quarter, again, bought at the end of the quarter, and if you could sell it right away, you're looking at like 3 days. If the stock doesn't go down 5%, 10%, 15%, whatever that discount is, maybe it's a no-brainer to go that route. If you have to buy it and hold on to it for a year or 2 years or whatever the requirement is, that's something you're going to have to think heavily about. We talked about RSU, or restricted stock offerings, bonus offerings, things of that nature, and what happens with that. And the general idea of, hey, that's my self-funded severance plan. Again, I would encourage you, be very, very careful of thinking that as a self-funded severance fund, because if the economy tanks or the company does bad, the value of that severance fund is going to get cut along with potentially jobs. There are better investments out there. I encourage you to do your own due diligence, see what's out there. I do recommend a couple stocks here and there, but as I make my gains, as I make my double my money and pull my money out, I look to put my money into ETFs. ETFs are baskets of money where all my risk isn't in one asset. And with that diversity, it holds up a little better as the market roller coasters up and down. Again, there's nothing wrong with holding individual stocks, but you have to know what the boundaries are. You have to know how to trade them. And I would just encourage you to take a look at it. Maybe owning your company stock is the right way to go. But if you don't have the ability to make decisions and influence that stock price, why not buy an ETF? Like and subscribe. See you.